Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, Head of UK Rate Strategy, and I'm joined today by our global market specialists, Nevruzi and Joann Spadigam. Okay, bumper week this week for data in both the US and the UK. But let's start with the US because I think that was on a global scale, as much as I'd like to talk about the UK, probably a bit more hotly awaited. So like I say, that long-awaited inflation print, what did we learn from that this week, Jan?
The inflation print itself didn't really surprise too much in either direction, I should say. We got a headline number of 0.5 month on month, in line with expectations, similar with the core inflation number, which excludes food and energy. We got 0.4, similarly in line with what the market was looking for. Within the breakdown, once we're digging kind of like component by component wise, I think three things really stand out. The shelter measures, which are, as we've discussed before, lag the spot market and new rentals. They are declining, or at least they have declined compared to the previous month. That's one. So, and they do make up a large portion of the entire index. Something about 30% is just the shelter component. So once those start going lower, they will also mechanically drag the inflation index lower as well. But the second is that core goods prices, which, as listeners will remember, have contributed to the drag in inflation and have been in negative territory for the past 3 months, now have firmed up a little bit, even a little bit firmer than what we expected. Things like car prices didn't fall as much, and they didn't necessarily rebound in any sharp fashion, but once you go from like negative any number to zero, it still will increase the index compared to the prior month. And then finally, the core services section that the Federal Reserve and a lot of economists and market watchers have been focusing on as the pain point for inflation, that came a little bit softer. It's showing it is certainly trending in the right direction, particularly core services ex housing is now drifting towards the target. So all in all, I wouldn't say it was really a mind-blowing inflation number in either direction. But coming after the non-farm payrolls, I think people were looking for something to feed that hawkish narrative, and inflation didn't show a substantial deceleration by any means. So that kind of added more into that pressure. On net, I would say not really bad news, but nothing really too good to take away from this week's number as well. And we just got the PPIs, which confirmed a similar message. They just came out before we got in this room, so we can and they're not nearly as important as a CPI. Oh, one final thing about the PCE, for CPI, I should say, is that the Fed tracks the PC deflator, and the weakness in the core services is just not going to spill as much into the Fed's PCE measure, because of the different weightings and the different, methods that they use to feed into, for example, medical services, right? Like they'll just use a different measure to calculate their medical services compared to how the CPI does. So in fact, we could see an acceleration in core services within the PCE, while the CPI we saw a deceleration.
And just for listeners to be clear, PCE stands for personal consumption expenditure, and that's essentially another way of looking at inflation. We often talk about inflation, certainly in the UK, in terms of kind of CPI and RPI, but PCE is just another way of, I guess, analyzing price movement in the US. So digging into that, Jan, into what you said around what the market was kind of looking for, particularly post NFPs, we had quite an outsized market reaction after that inflation print. The market moved pretty quickly to price in more Fed action this year. We saw the curve flatten quite significantly and yields rise, led by the front end. Was that really justified, or do you think that's gone a bit too far now?
Whether it was justified, post payrolls, as we discussed, I do think it was justified, but do we think it's gone too far? Yes, we're on that page. We think particularly the 3-year sector has grabbed our attention. We do think yields there have moved to attractive levels enough to bring in more demand. And I think the fine balance there is between, well, how far is the Fed going to keep pushing the narrative that they have to remain on tight monetary policy stance for longer periods of time versus how much the market can take out further out from the curve in terms of rate cuts, right? So the very front end is up to 2 years, let's say, it's very susceptible to the Fed jaw wanting rates higher. And that has been happening too. Not that the 3-year did much better, but we do think that it will be very, very hard to take out the market pricing of cuts entirely. You could just roll them down, but still that area seems like the sweet spot for us where, well, we think January had some strong data, true, but that can turn around, and we don't really think there has been anything to justify a reevaluation of Fed monetary policy like we had in last June, where hike increments were bumped up again and where the terminal rate was materially reassessed higher. Can this inflation number justify, say, another 25 basis point hike? Sure, yeah, that can, and market's already priced in for that. But do we think that's going to lead to the Fed going back to 50, 75 basis point hikes? No. So because of that, we still think this bull steepener is the trade for this year. Of course, as we pointed out in a year ahead outlook, so that it wouldn't have been a theme that was going to materialize in January or early in the year as well. So it's kind of like a delayed fuse bull steepener, because at some point, and it does feel like that point will come soon, the Fed is reaching its peak, and we find the 5-year sector to be a little bit too rich now, but the 3 years kind of like our sweet spot for duration, and for curve views generally, we think overall the entire curve will steepen and follow it, and by the time in 3 years and onward, so like 5s, 30s, 10, 30s, cycle leading indicators or spreads, I should say, that would kind of once the Fed turns around.
So you mentioned there about the possibility of returning back to 50 bip increments, or the lack of possibility, I should say. I guess it's interesting that we're recording this on Thursday, UK afternoon time, and literally as we were kind of leaving our desk to come and record this, I noticed some headlines from Mester on the wires that seemed to be talking about 50 basis points. We've had a lot of Fed speak this week. Well, generally a lot of Fed speak since both the non-farm payrolls, the NFPs, and the inflation data this week. Your view then is that they haven't really changed their messaging all that much. I suppose there's still a whole nother round of all of this data before they have to make a decision about March. Is that going to be what we're now watching and what's going to matter the most?
Yeah, right. Let me clarify what Mester just said, because we just dived into it. But before we got to her, the Fed speak wasn't very pronounced in either direction. Everyone was repeating the idea that the Fed has more to do if inflation remains strong. There will be, more rate hikes to be done and more tightening that needs to be delivered. And all of this we already know. What Mester kind of changed up in the story here with the outlook for the monetary policy is, she said, "Well, I did think there was a compelling case to go with a 50 basis point increment at the last meeting." I mean, maybe, but she didn't voice it, and we'll see in the minutes if there was anyone actually voicing that in the meeting, or if it was one of those thoughts that in hindsight looked right, but at the time it didn't feel like it was justified. So we will see that with the minutes. They're due soon, and whether they can shift back to 50 basis points, I don't know. She's not a voter this year. However, the Wall Street Journal yesterday reported that Austin Goolsbee, who is the Chicago Fed's president as of January, could be appointed to replace the departing vice chair of the Fed, Lyle Brainerd, and he leans dovish. So if he moves away from the Chicago Fed, then the Cleveland Fed gets the alternate vote, and Mester would be a voting member. So I think that's why markets reacted a little sharply to her comments, despite, of course, bringing back the idea of 50 basis points potentially being back in play. We don't think that's the case. We think now they've lowered the pace. They might just add another one in June. Like I said, that's priced in. It's still not our base case that will maintain, the hiking cycle past May, but it doesn't seem outlandish, of course, but nothing like making a U-turn and accelerating the pace of rate hikes again. We just don't think the data justifies that quite yet. So we haven't really learned all that much from Fed speakers, except that one comment this week. And I think since we have another set of data, employment data, inflation data until we get to the next Fed meeting, I don't think the Fed Fed officials will be rushing to make these big conclusions that the Fed has to do X amount more. And we also got the date for Chair Powell's testimony in front of Congress, his semi-annual testimony, which will be on March 7th. So that comes just before the blackout period, a couple of days afterwards. So I would imagine he delivers kind of like the final message as we head into the March meeting. But moving away from the US, we also had a lot of data in the UK, and not that we don't every week, but this week also felt particularly impactful given market reaction. So what were the main takeaways from UK releases?
Okay, we do get data every week, but this was, of course, the big data week. So it did deserve a bit more attention. We are recording this on Thursday, so we haven't yet had retail sales, which we obviously will have had by the time listeners listen to this. So I won't comment on that, but I will just say that I think anyway, in terms of the market reaction, given the data that we have already had this week, both on the inflation and the labour market side, I think that they are much more important in terms of trying to take a steer for what that means for the Bank of England than retail sales tomorrow morning does. So although we don't yet have the full picture, I don't think any different number tomorrow would particularly sway me, largely because, and I think, we talked about this last week, but largely because retail sales is already flashing, I guess, we can call it sort of disinflationary signals versus where we have been at this point in previous cycles. Whereas when you look at the inflation data and when you look at the labour market, they're still flashing quite inflationary signals, and it's that obviously the Bank of England is most concerned about. So the data this week, I think I'm kind of terming it as something for everyone week, in that I think that whatever your kind of prior narrative was heading into this week, whether you thought that the bank weren't going to hike again, whether you thought they were going to do 2 more 25 bip hikes or just 1 more 25 bip hike, wherever you sit on that spectrum, I think you can justify that stance with the data that we've had. The labour market data was pretty mixed. On the kind of more dovish side, average weekly earnings was lower than expected. We had inactivity falling, and we had hours worked falling. But then on the flip side, the strength in the payrolls number was huge. That came out at over 100 versus just 100K, I should say, sorry, versus just 15K expected. And the average weekly earnings ex bonus measure, which although, in principle, it's the total measure that really matters, actually, given the time of year and, with bonus pay and bonus season, etc. at the moment, perhaps the average weekly earnings ex bonus number is what really gives us a better guide for the underlying wage pressures. And that was higher than expected. So all in, I don't think that there's enough in that labour market data that would make the Bank of England comfortable that the labour market is turning as quickly as they might hope to kind of take some of that pressure out of wage inflation. Then we also had the inflation data, which again was a little bit mixed. RPI, the retail price index, came in line with expectations, but CPI, which is the consumer price index, a slightly different measure of inflation or a different basket of goods, came a little bit weaker than expected, both on the headline and the core measure. Now, of course, that in itself might provide some comfort to the Bank of England, particularly, I guess, core, although it was still at very elevated levels, and it doesn't really change our view that it's likely to be sticky going forwards. But the weakness here was really concentrated in just a few factors that either A, may well be kind of one-off and might reverse in the coming months, or B, might be due to kind of January sales as well, and therefore, again, may well reverse in the coming months. So yes, there was a little bit of weakness on the kind of CPI print, but I think given that it wasn't really broad-based weakness, plus the fact that you have this kind of stability in RPI, probably brings into question how persistent that the weakness in that headline CPI number might be.
Right, and you mentioned what the Bank of England might feel about each of the releases, but just to summarize, what do you think this data will have how this data will end up influencing the decision? Has that changed your bank rate forecast at all?
Well, I think just about everyone else, as I was saying, there's something for everyone. I don't think anyone's changed their mind on what they previously thought the bank would be doing this week. So we were firmly in the camp of seeing one more 25 bip hike in March with upside risk. So definitely think the risks are skewed towards either there being a 50 bip hike in March, more so than there being no hike, or perhaps more likely an additional 25 basis point hike in May, which would take peak rates in our central scenario up to 4.25, or in that kind of upside risk case to 4.5. So that's really unchanged since all the data this week. And like I said, I think actually the data probably supports the notion that the Bank of England won't be comfortable enough yet that inflation has turned and that those second round effects aren't there, that they would want to take their foot off the gas when it comes to hiking rates. The market, I think, interpreted it in the same way. We've actually done a little bit of a round trip in front-end rates this week, but I think the market largely interpreted it in the same way. At the time of recording right now, we have about 35 bips of tightening being priced into the next two meetings, which seems roughly fair to me. Like I say, we think they do 25 with upside risks over the next couple of meetings. So I wouldn't push back heavily against that. We did get to quite extreme market pricing at some point this week. I think following the labor market data and the beat on US CPI, we saw something like, close to 45 basis points being priced into the next two meetings, which felt high to me. But where the kind of dust has settled now, I think feels quite reasonable.
Yeah, and moving a little bit past the front end, like the overnight rate, but there was a lot of volatility across the yield curve as well. Big underperformance, which was followed by a big outperformance. What is driving all this? I guess the data is one of the answers, but anything gilt market specific, I should say, that we can enlighten the listeners about.
So yeah, I guess it mostly has been about the data this week. We've seen a big underperformance, which has been led by the front end, essentially, as we have repriced bank rate expectations. And if you remember 2 weeks ago, we had that trio of central bank meetings in 1 week. We had the Fed, the Bank of England, and the ECB. And although all were very dovish all were more dovish than expected, I should say. Not very dovish. It was the Bank of England that was very dovish. Gilts outperformed off the back of that. And at the time we said we thought that was a little bit overdone. So I'm not surprised now that we've seen some stronger data kind of supporting the idea that the Bank of England will still need to hike at least once more to see gilts underperform and it be the front end that's kind of leading the way there. But I do think that probably with sort of 2-year yields at where they are now, about 370. If we're talking about bank rate getting to 4.25, and bank rate expectations shifting to perhaps expecting cuts actually in 2024, I think 2-year yields at 3.7, 3.75 is probably roughly fair enough. So although I do think that there's further room for gilts to underperform, actually I think the heavy lifting now should be done by the longer end of the curve, which has kind of lagged the move a little bit, particularly the 10-year sector of the curve. That, if you look at gilts today on Thursday as we're recording this, it's really that part of the curve that's lagging. And I think there's room for that part to underperform more. As we head into next week, we've got a heavier supply next week, which then continues for a couple of weeks. We're back next week to it being 2 DMO and 2 BOE auctions, which remember weighed pretty heavily last week as well. That was a kind of trigger for a weaker than expected auction from the Bank of England at the end of the week. And that kind of heavy supply schedule persists. We usually expect supply this time of year to be taken down by in pension and insurance, so LDI in particular, as we head into the kind of fiscal year end here in the UK. But actually LDI haven't been buying as much as we would have expected at this time of year. And so, that demand perhaps isn't there as we would normally see. And we're seeing further evidence of a kind of lack of foreign demand as well. We saw that already in the ONS data, but we saw that this morning in the US tick data as well. They were sellers of gilts again in December, and we think that's going to continue. So we think that the underperformance of the UK can continue, but probably expect that to be further out the curve than we've seen this week. So similar to what you were talking about, Jan, I think that we should see curve steepness from here, and that front end should remain better pinned. Okay, that's enough on UK rates. Joann, let's move over to Europe. I think Europe has been a little bit overshadowed by everything that's going on in the UK and the US this week, but perhaps you can give us a quick takeaway of what's been important in Europe this week.
Yeah, so it's been quite a quiet week overall in terms of Euro area macro developments. But I do think the Europe area has just been slightly been driven along by what's been happening in both the UK as well as the US, of course. But I think the US data itself, the strong labor market data from a few weeks ago, as well as retail sales, does really speak to a story in the euro area as well a little bit, where we do expect that growth in the euro area will be better than projected last year and better than forecasters across the world really expected. We've already seen some of these growth estimates go up in recent weeks. I do think that the data we get next week, for example, the ZEW survey expectations, will reflect this as well, that growth in the euro area is actually just going to be better this year than initially expected. I think other than that, the big theme in Europe really is supply. We've had two big syndications this week, one from Belgium and one from Italy, both to the long end. And these have been well received, but I do think the question really comes in terms of the auctions, which have been a bit more mixed. Supply from Spain and France was a bit more mixed today. So I do think that kind of speaks to the supply indigestion we should see coming in over this month as markets really grapple with this a large amount of supply that we should have for February. To put the numbers into perspective a little bit, the amount of supply we have in February for this year is estimated around 75 billion euros. And that is around 2-3 times more high than it was in February last year. So there is quite a lot coming in that markets really do have to grapple with. And to add to that, I think an interesting point is just on gross ECB reinvestments, which should slow which usually slows a little bit in February compared to January. And I think as well, going into March and QT, that supply again, that those reinvestments again kind of step back, which should provide a bit more of a bearish story for rates from there as well.
Speaking of the ECB then, I guess the European specific news, I suppose, that we also got this week was the ECB bulletin. And we've had a kind of flurry of ECB speakers as well, as there always is. Was there much to learn from any of those this week?
I think the ECB speaker that was really interesting for me this week was Panetta. I think just over the last few months, if you look at ECB headlines, I think it's quite difficult to really understand who's a pork and who's a dove. And I think we're starting to see a bit of that balance return to the council and how they see the outlook really. And Panetta brought that with his speech. He, I think, highlighted a few things that we thought were important before, which was in terms of inflation, firstly, how quickly it's come off versus what the ECB thought previously. And secondly, the fact that really we could get these revisions downwards to the inflation forecast in March. Also, given fiscal policy may not be as large as maybe expected for the previous inflation forecasts. So I think those messages from Panetta really did provide some balance to the more hawkish messages we've had from Not last week and Schnabel as well. So it's really offering a bit more balance in terms of how the ECB could see things in the March meeting and more in line with our views, I think Panetta is. In terms of the actual bulletin, it did confirm the messages from the ECB meeting. There are a few points I thought were worth mentioning. The first one was on inflation, where I think they showed quite a lot of information about how inflation's come off. So it's not just in energy, it's also in food prices coming down quite a lot as well. And as well as in supply chain pressures, which have been elevated since COVID because of China lockdowns and such. So we are seeing inflation coming down, not just in energy, but over a few different factors. The second thing I thought interesting was on China and energies in particular. We've got lots of back and forth in the team as well about whether China will be inflationary, deflationary. I'm not going to weigh on that today, but just to note that for the ECB as well, at least they're talking a bit more about what China reopening means for LNG supply. So before COVID, I think China was a big LNG buyer, and because they've slowed down and had lockdowns, there was a bit more LNG supply for Europe to really take on when Russia cut off their gas supplies. So the question really is for the end of the year is what happens to energy if China rebounds and needs to get back this LNG demand. They do have pre-existing contracts. So one scenario could be that China does indeed go back to these contracts and to start to suck up LNG supply. But obviously there are other factors to consider. Will the winter for next year be as warm? Will gas storage be high? Will China just move to a completely different source of energy like coal? So lots of unknowns, but I did think that was a really interesting article for the ECB to kind of write about this time around.
Yeah, nice. I'll leave it up to the listeners to decide who's on the inflationary China reopening camp and who's on the deflationary. I'm sure that is something we will return to on the pod. Yeah, and also I guess it's interesting what you highlight with Panetta, because we have kind of consistently been on the more dovish end of the spectrum when it comes to market pricing for the ECB, notwithstanding how front ends have moved this week, as we've already discussed in the UK and the US. But even before that, we were expecting a slightly lower peak than what the market has priced in, and that seems to fit that. Okay, great. That's probably enough for this week. Thank you both for joining me, and thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.